Hey guys, I'm with Kashop today on the Holy Macro Show. So, if you guys have any charts, any requests that you guys want us to take a look at, feel free to let us know. I can always bring up charts. I can always talk through trade ideas, whatever you guys want to do. So, let me know if you guys want to look at anything specifically. Um, so, today we're going to talk about a couple things. And first off, before anything, we should talk to, I want Kashop to answer to all the haters about the Bitcoin trend. So I am finding it funny to sit here because really like trading is very specific. It's kind of like when something like Nvidia goes up like crazy and people are like, I can't believe you didn't buy that. And I'm like, well, I don't ever buy individual stocks. So it's like every trader is different. Every trader is going to have some strategy that they're running that's going to be different from everybody else. So Kashop has been posting about Bitcoin a little bit and getting a lot of heat about like him selling his positions. But I just want to also clear up. Kashop and I have been long Bitcoin for since it was like under $1,000. So it's not a big thing to really go. Okay, we're gonna take some of the position off. I am personally still long. Kashop is out. I want to hear about his position, why he got out of it, and then answer to why is everybody so against people exiting good trades?
That's what puzzles me. And I think it goes back to the difference between we are traders. For us, it's totally perfectly fine to move on. But for someone who's not a trader, and especially for someone who's kind of made Bitcoin like their church or a part of their social identity, for them, it's extremely difficult to imagine moving on. And I have a friend who used to be a Jehovah's Witness until he was 24, and then he kind of got out. And from his experiences, I can sort of understand how it is. And I think that's pretty much all there is to it. So the reason why I got out, so I got out first in February, which was when I talked about the exit strategy. And I mean, I got out of Bitcoin, but I still had my other crypto version. So I had Ethereum, I had Solana, and Solana is I actually got into Solana sometime around the $11 range back in early 2023. So it crashed all the way to $8 in 2022, and then it had a nice smooth rounded bottom and started trending higher, which is when I bought it. I sold that for a quick double and then thought nothing about it because it was just a trade. And then once I started looking into the technology, and when I saw Robinhood delisting Solana and crashing it right back to something like $17 or $15 or something, that's when I realized that this should actually be a long-term venture capital style investment, which is when I got in heavily, and because I'm a trader, I pyramided the position as well. So the core position, what I did was I held it offline in cold storage. And the big position, the pyramided one, what I did was I traded it in and out. And that's just how I treated it. And recently, what I did was when Bitcoin had this big up move, so it got out of it was in a very tight range from March all the way to October or something when it was at 68K, and I had put out a chart saying when I see this uptrend, when I see this sort of megaphone pattern, Bitcoin breaking out of it, that's when I'll get deeper into crypto, but maybe not allocate as much to crypto this time around. And the reason for that is gold is picking off, and I know I can get much bigger returns and hold the gold stocks for a much longer term than I can hold crypto, because crypto is moonshots and busts. It's just so volatile, and you really have to time it so perfectly that this cycle I just decided, you know what, I've had enough. I'm not going to put too much capital into crypto this time. I'm just going to focus on having a quieter, less volatile life and not worry so much about the gains, because once the gold bull market picks up, the upside really takes care of itself. So I don't really have to sit here and feel FOMO. Oh wow, Ethereum is up 50% in a month and I sold it too early. It doesn't really matter, because there's going to be a point where it's going to be down 50% in a month and everyone's going to panic. And I'm going to be like, okay, let's just wait for this level. And if it clears, then let's just buy it the same way I participated in the current crypto cycle. So to me, it comes to there's this one Ed Sekota quote which I posted in the replies to one of your tweets, where I said, everyone gets what they want out of the market or what they deserve out of the market or something like that. And that is so true. So, what I want from the market right now is I had a good year and I just want to relax. That's it. I don't want to think about trades. I don't want to be glued to my screen. So this is the first time I'm actually experiencing winter. I come from a hot tropical climate and sitting in Dubai in the desert. It's now 18 degrees Celsius outside. So it's super fun. I just want to go walk in the park. I just want to go sit out in the balcony and enjoy the fog or the mist. Just do all the outdoorsy things which I haven't gotten to do. So that is what I want to do. I don't want to sit in front of my screen and be like, oh wow, Bitcoin's gone to 103K and then it's flash crashed to 91K. And then on South Korea, it's gone to 79K because there's some coup or whatever going on. And I don't care. Like, I'm out. I'm sitting on USDT and Binance says they'll give me a 23% yield if I just sit on USDT. I'm happy to take the trade. T-bills give me 5%. I'm happy to put money in T-bills and just sit it out as well. Because what I want out of the market right now is a little bit of rest. And so that I can have my chill time, I can recharge for the next year and try to have another great year. And that's what I want. I don't want to be sitting here in front of my screen looking at all my past trades and be like, so I got out of Solana at 220 and I think it's like around 235 now. I'm like, I missed $15 per coin. Had I just held on, I would have made an extra $15. Like, no, I don't want to torture myself like that because there'll be a point where it crashes 25% because crypto is volatile. Nothing to do with Solana or Bitcoin or any other crypto. These are just so volatile that I wouldn't be surprised to see it crash 50% in a day because it's done that before. So I just don't want to be involved in all of that. I just want to dissociate, relax, and it's tax loss season. I enjoy buying gold miners this time of the year. So that's what I'm doing. It's a very long answer, but you asked the question.
No, I like it, and I think it's very important when you're thinking about trading. Trading is this very mentally tough thing. It's so mentally tough that it's mentally draining. It hurts your mind, and if you continue to be on that path for too long, like it could really take a lot out of you. And for me, as a trader, I always keep that stuff in mind. It's the whole reason I run the strategy I do. It's so I don't have to sit there and stare at it all day long. And I think it becomes even more important as a discretionary trader. If you're a discretionary trader, you have to take more breaks than other people. Me systematically, it's I even need breaks. My systems are partially systematic. The way I find my trades and what I'm trading is not exactly fully systematic. But once the positions are on, once I'm taking signals in the position, that's fully systematic. And because of that, I really try to um, have the ability to turn everything off at certain times. You don't, and also people don't know everything that goes on in people's personal lives. Personal life trauma and things that happen in your life also could be a reason to take a break. A dog dying, a family member dying, something like that, a bad relationship, something. You hear it all the time, and I forget it was a really large hedge fund, maybe it was Bridgewater, but when people were going through a divorce, they would turn off their accounts. You read that same book, Steve Drobny book.
More money than God.
Yes, yes. So that book is it talks about that in it, where they basically end up saying, hey, you're going through this, we're gonna shut your accounts off for a month, you're gonna pay you a salary, go home. And so these things are incredibly important to understand as a trader. And I think all the, hey, buy this, sell this, that all sounds really cool. And it's what brings in subscribers. And I'm not hating on it because I also understand, the business of trading is to get people interested. And to get people interested in a product, you're talking about trade ideas and all these things. But really, the answer to all of that is less trade ideas is actually how good traders trade. And it's funny to talk about because somebody, this is a conversation that's been coming up with other friends recently, which is, how do you balance trade ideas with just good trading? And like people talk about, well, I put out all these trade ideas all the time, but it's not, I wouldn't trade all of these ideas. And for me, I'm the opposite, where I don't put out many trade ideas, but it's because I'm trading all of the ideas. I don't put out anything that I'm not actually trading. So it's you have to really understand like the market around you is trying to instigate you to do things all the time. The market that you're trading currently, like in your own mind, wants to be more active, and sometimes the ability to turn that off is amazing. Like that's awesome. You get to hang out at home, to have a winter, like see what that feels like. Like that's really interesting. So it's like, why not take a break, go see what's going on? You have had a really great year. You've made some great calls. Pick up your gold miners when you want to, and run into next year.
Yeah, that sums it up. So let's talk about your year-end strategy. So I know you have uh, a ritual, or I don't know what you call it, where every year, I mean, I think how many years have you been consistently profitable?
It's been since 2020, it's 13, 13,
Since 2013. That's
profitable
awesome.
since
So
13. And then outperforming the S&P. I've done that for the last since 2018. I've
wow,
outperformed the S&P since 2018.
wow. And we had this conversation in private where you said that every year you start with a clean slate. Now, I know that doesn't mean you just close all your positions on December 31st or the last trading day so that you start with an actual clean account. But what it means is mentally you just here's my PNL for this year. I'm going to celebrate that PNL, enjoy my success, and then come Jan 1st, it's a new start. It's a blank slate. It's a new beginning. And I don't care what I made in the last year. The next year is all about making money again. So it's like you get up in the morning, you go to office. The next day, you get up in the morning, you go to office again. And the two are not exactly related. So talk about how you do it in your own mind.
Yeah, so that's a really good point. And so for me, I think it's really important for traders to you get stuck into well, I had a really good year last year, and it's you can be great at something, but to be really great at something, you can have a great year, but to be great at something, you have to do it again. It doesn't matter that you did it once. So how do you do it again? And it's really hard because as a trader, for me, I don't think about outperforming the S&P 500. That's something that so many traders get into, but I'm glad I do. That's great, but really having the ability to look at it and go, I don't think about that at all, because I'll see people hit me up all the time and they'll be like, well, this quarter or this month I did not perform the S&P 500. And I'll be like, yeah, you're never going to do it every month and every quarter. And for me, I had a year in 20, what was it? Maybe it was 20, I don't remember what year it was. Maybe 2019, because it was bottoming out. I think most of the year I didn't outperform the S&P 500 at all, and it was the end of the year where I had this great return in the year end that outperformed the S&P 500, and it's and by quite a bit actually. And I think of 2020 where I had two back-to-back 50% months in November and December, and you think about that, and it's how do you outperform the S&P 500? Well, I could have been completely flat all year long in 2020, or actually lost money and still outperform the S&P 500 by the end of the year if I just had those back-to-back months. So I always talk about it like lumpy returns. Like first off, you got to think about returns are lumpy. Don't worry about outperforming the S&P 500. And the more you're not doing that, the more you're going to have this crazy return over certain months or certain quarter. that you're not going to be able to replicate any other way than to just be ready and have the positions ready to do that. And so that creates the good returns per year. But if we get into what happens the next year, that's the ability to do it again. So the next year is like, okay, we go back to zero. And I post this on everything I've ever posted is, we go, I could have a great return the year before and it's always zero the second January 1st comes. And I had people ask me about it, before, like, why do you do that? It looked so much better if you did. Because I watch people, especially in the space, and honestly, I don't know if half this stuff is fake because people posting 1,000% returns. I'm very skeptical. You'd probably live on a yacht. Six for me. I work very hard for my 70% CAGR. That's as good as I could ever get that. And it's as good as I've seen in most of the industry over the years too. So kind of getting to those points are like you got to really understand what's out there too. Is if you're looking at the S&P 500 and going, I got to outperform that, and then you're looking at the friend over here who's saying he made 1,000% last year and it carries over into his next year and he's making the 5,000% the next year, and that just also sounds ridiculous. So you got to think about like what's realistic. So for me, what I do on my platform is try to think about what I do as a trader. So as a trader, I put out there, okay, I'm back at zero, because as a trader, nobody's paying me for what I did last year. Like nobody gives a shit. They're just gonna go cool, and not to mention I don't have to pay any taxes, on what I'm carrying over into this year. I have to pay taxes for last year. So you put the return out there, you understand your taxes, you understand the implications of that, and then as you move forward into the next year, it's zero. It's a clean slate. And we usually start, and every year it's funny because I'll watch people go, oh my God, you're down 2%. And it's like, yeah, that's how every single year starts. Every year, the first month or first week, 2 weeks, could be choppy. You're going to chop around, but I think it also really leads to people really seeing what I do and understanding like, hey, this dude's for real. He puts out his actual returns every month, good and bad. The losing trades are on there. The winning trades are on there. The ETF portfolio this year is having an insane year where I haven't had to do anything with it, which is ridiculous. That'll probably never happen again. There just haven't been many losers in it. Actually, any losers in it. There's one position, which is Saudi Arabia, which is the lone loser, but everything else is a winner. So you just really have to think about it like, what would you do as a trader? If you were a professional, how do you make money? Do you make money, carrying money over from last year to this year? No. Would you make money being at zero and trying to produce a return every single year? Yes. And so that's how I think of it. And also, I set my returns for most of my clients to a year return. So most companies, they set them to quarterly. So they'd make a little bit quarterly. I try to leave it all the way to year end, really understanding like that's the time frame I'm really trying to hit. That's the trends I'm really trying to hit. I'm not looking for big spikes per quarter or anything like that to bring more money home for me for my fees. I'm looking to enrich my clients' lives and make them a lot of money as well as make me a lot of money because I'm doing a good job for them. And then if I'm not doing a good job for them, I'm not making shit. So looking at it that way kind of helps me to clean the slate, go, okay, Jason, now you got to do this all over again. That's it.
So, how do you think about doing it on a calendar year basis versus doing it on a rolling 1 year basis? So, when it's your own money, when it's your client's money, then it's different because you have a tax year and you kind of have to make sure you pay taxes. So that affects the way you think about it. But let's say you're working for an institution and they don't really the burden of taxes isn't on you in that case. So then would you go with the rolling 1 year PNL or would you still stick to the calendar year format?
So it's still the calendar year format, and for I've had clients in the institutional space. I still have a client in the institutional space. So I mean, when we do that, it's the same thing because once again, yes, for them it doesn't matter as much, but for me, I'm also still getting paid on this 1 year time frame. So because I get money at the end of the year, it's still exactly the same. I just think that generally, if you're looking at carrying over your returns, and I think it's more important for this way. Think of it this way: everybody in the world loves to carry over returns. It sounds great. I would love to take my 60 something percent and carry it into next year and say I'm up 60% on January 1st. Sounds great, but nobody wants to do that with a loss. Everybody would happily cut off a loss and go, you know what? I have a clean slate now. And I think that's important. That's an important thing in our psyche is going, okay, well, you would want to do that with a loss, but why not a gain? So let's do it with both. Let's just go. We have a clean slate, move it forward. Sometimes if you're with a fund, like most of the time, you have to get back to that even point. If you did cut that out, you still have to get back to that even point until you make money. However, you still don't want to get into that mindset where you're carrying over something from last year. You may have made some mistakes. For me, I had a good 2022 considering the market was down 20%, bonds were down 20%, and commodities were getting hammered, and everything was in a pretty bad state. But I did feel like, the last 3 quarters, I could have done some things differently. So for me, kind of getting to start over again in 2023 and just looking at it like a clean slate. Also, it helps me with other things. Like think about technology in 2022. Coming into 23, like we were, and a lot of people forget about this now because everybody in the world says they bought the bottom in October 2022. Nobody has any proof of this, but everybody in the world says they all bought it. And if you look at it that way, really what the market was looking at that point was recessions. The Fed was still raising rates. There was a lot of pain out there. When they stopped raising rates, the rates were very high. Mortgage rates were very high. We basically were looking at very tight liquidity. And we were heading into recession. And then you get all these buy signals in 2023. Now my brain could have been back into Q4 or Q3 2022 and going, oh, well, this thing happened, this other thing happened in these quarters. Therefore, I don't want to take these trades. I don't want to do that. Or I can just clean slate, not think about any of this stuff. Because I think this is the hardest thing to do as a trader. And this is going to sound really boring to people, but this is like the ultimate, like, holy grail, which is the ability to just continue to take the next trade. Like not even care. Like I mean, everybody knows the way I trade on here at this point. Like a lot of people know me. I will always take the next trade. I posted that Coco chart a billion times. Like me taking trades for 5-6 years and getting hammered in Coco, slight gains, slight losses over and over again, and then one huge trade up a couple 100%. You just take the signals. And to do that, you have to have a short memory. And I think part of that is the ability to come into the next year and be like, well, I don't care that the NASDAQ's PE ratio was this. I don't care that the semiconductors look like this. I don't care about my feelings about all of this the market. I'm just going to take the signals as I get them and put on the next trade because I'm at zero all over again. So I think that's the most important thing to do as a trader. Just understanding your process, whatever it is. It doesn't mean, everybody's process needs to be exactly like that. I'm saying understand what your process is. Maybe you have to come into a year and you got killed trying to buy dips in, let's say 2017, 2018, and 2019. And let's say it's 2020 and you get this huge dip in COVID and then you didn't buy it because you were afraid of those dips because let's say you're a value type guy and you're afraid to buy another dip because you got killed by it, and then you missed out on basically the dip of the last 5 years by not buying during those periods. So it can be used in a bunch of different ways and thought about a bunch of different ways, but I generally think it's a good thing to just be able to clean the slate and come into each trade like it's a new trade.
Yeah, I think that sums it up perfectly. So I have, let me just share something and then we can talk about it.
Where'd you put it?
I'm just uploading it. I'm not sure if you can flip the image here. Let's just check.
Yeah, the share
Because,
part. Oh, okay, I see it.
yeah.
Yep. Oops.
Is
Why
it
is that
possible to flip it?
I don't
Are
know
you
why
trying
it
to flip it?
flipped.
No, it flipped when I downloaded it. I don't know why.
Oh, okay.
Let me just.
Let me. I'll pull that up. I know what it is.
Okay, yeah. So
So
because
Doug
we are
Cap.
talking about returns and realistic trading and how it is, and you are a trend follower. So I just pulled this chart of a trend following portfolio, which has a fantastic long term record, but it has multi quarter and I think in a few cases a multi year drawdown as well. So let's talk about what it's like to actually continue trading a strategy when you have that kind of drawdown. Because now most people, and that's including myself, you try doing something, especially as a discretionary trader, you try a strategy, it doesn't work in a particular market environment, and you're like, you know what, I'm going to give up on that strategy. Now, as an individual, as a discretionary trader, I think it makes sense because if something is not working, you just move on to a different strategy because you're discretionary. But if you're a trend follower and you have a system and that system works, but that system does have drawdowns, then you cannot really say, I'm going to kill the system just because it's in a drawdown, especially when it has a great long-term record. So, how do you think about this? Like, would you invest in a fund which has this profile, and what does it take to run a fund which has this kind of return profile?
So for me, there's I love trend following, so I'm not gonna say anything bad about any of these guys because once again, the one thing I will always say, these guys have been in business a lot longer than me. So what I'm saying is kind of null and void, and I would go more their direction than anything. And if you look at parts of their curve, there's drawdowns, but they're very quick. In other parts, they weren't. So if you go into the 2000s, basically, you see their drawdowns are pretty long term. They're not only quarterly, they're yearly and multi years at times. The one from looks like 2000 to 2006 or seven. That's a multi-year drawdown. Many years. And so the one thing that I looked at when I started to build my trend following models is what could I build that would not have this type of long-term underperformance. Sometimes the what I found when you go back on trend following is sometimes the allocations to areas are too high. For example, you're starting to buy a ton of commodities in the 2000s, let's say, or sorry, not 2000s, in the 90s. Basically, at a time where equities were the major outperformer. And then also, if you go forward, you see there's some underperformance in the 2010s. And what's that underperformance, and why did that happen? And that's the same thing. They're still looking at too many commodities. And then also, when you looked at 2000 to 2008, the underperformance mainly happened because they stopped at certain points buying so many commodities. So you see this happen a lot in these types of markets where all of a sudden they're like, hey, we've been getting killed. Let's start pulling commodities out of our portfolio. This isn't really working out so well, like the 90s, even though they did very well in the 90s, all things considering. And so you look at that and you go, okay, these guys, a lot of the time they pull certain things out of their portfolio or they grow to a certain size that makes them have to think about it in a different way. For example, you can't trade lumber when your size of your portfolio is something over, let's say 100 million. You're not trading lumber at 100 million. You're not trading orange juice at 100 million. You're not trading cocoa even. So a lot of these products start to go out of your portfolio. And so then how do you really make these crazy outsized returns at that point? Well, you don't. You start to get in these drawdown periods. You start to get under allocated to equities. So a couple things I started to do differently. I started to go, okay, well, a lot of them at that time, especially nowadays, Jerry Parker is a very different trader. He does, individual stocks all the way through in his trend following portfolio, which is really cool strategy. Um, so for me, I wanted to go, okay, I want to be in these sectors. I see that there's a lot of diversification being in sectors. I also see there's a point where you don't want to, and it's a systematic point where you don't want to invest in stocks at the moment, whether it's sectors or individual stocks. You really just aren't going to make money in many stocks. Whereas most trend followers would say, continue to take the signals as they come. I say, if you're getting monthly closes below a 12-month EMA, don't touch the stock market. And that's another reason why I think my returns are a little bit smoother than a lot of the other portfolio managers. Also, I run, or sorry, trend followers. Also, I run a portfolio of mean reversion strategies too. So when I'm looking at equities and you're looking at all these equity sectors, I also have mean reversion strategies and I have false breakdown strategies. These diversify my portfolio quite a bit more, so the drawdown periods seem to be, as far as back testing goes, the drawdown periods are a lot shorter. So I think that's some of the reasons why. But once again, it still comes to the question of what do you do when you do have those periods, because they're going to come up. And I also brought this chart up of Mulvaney's returns. And so this is fascinating to me because, this guy, the last few years, people have really started to take note of what this guy does. And he's had some phenomenal returns, and he doesn't run a little bit of money either. So it's really fascinating to watch this. But if you go all the way back, you don't, and this is important, I think, for all traders to understand. Understanding that everybody has underperformance. Everybody, discretionary, systematic, people like you mentioned earlier, like discretionary, you want to just change something to fit the market sometimes. But what you find out a lot of the time is when you change something, that's when the market kind of comes into your favor. And then that's a period where you want to be doing that strategy. For example, trend followers got the crap kicked out of them from, let's say 2015 all the way to 2020. And by that point, if you kept with the trend following strategy, you started making a ton of money again. They were hemorrhaging money, but they just weren't making, they weren't outperforming anymore. But 2020, 2021, they had massive outperformance. They did really, really well in the market. I mean, look at Mulvaney's, 2020, 2021, 2022 return. These are really good. So the thing you want to do, no matter what type of trader you are, is really stick to your strategy. Whatever it is, like I think diversifying if you're systematic like me, finding different, nothing wrong with finding mean reversion strategies or other strategies that will smooth out your returns. There's nothing wrong with that. But whatever trader you are, you want to understand what your strengths are. If your strengths are being able to buy certain things at lows or before they turn around or something, that's a strength. Then leverage that. If your strength is buying high and selling higher, like myself, like you want to leverage that, be good at that. And just understand that there's going to be plenty of times where buying low is going to kill you. Like, for example, right now, everything's ripping higher, buying low is very hard. But at the same time, it's the same with buying high. Like buying high can kill you at certain times. So just understanding that your strategy is never going to be 100% in your favor at all times. And then, as what I brought this up for is if you are a trader out there and you think that being a professional trader means that we have good returns every single month, that's completely wrong. And I think that's important to say because people who are out there watching and they see professional traders or they see people on Twitter and they go, these people know something that I don't. And so because they think we know something different, they go, okay, well, like Jason Shapiro, he'll straight say, he has had plenty of months that are down. He's had plenty of bad trades. He says he loses 40% of his trades. That is one of the biggest individual institutional traders in the world telling you that he has plenty of losing trades, sometimes over 50%. He said he gets about 40% of his trades right. So that because of that, you're gonna have these months that are down months and that are bad months. The big thing, you just don't want them to go out of your parameters. Meaning, you see Mulvaney has pretty high volatility. It has 16% down months, but you don't see like 50% down months. You don't see years that are hitting like, 50% down years and massive drawdowns that you can't get out of. So you mainly just want to see that these are going to fit inside of your strategy and that the drawdowns are not going to kill you. And understand that drawdowns, down periods, down months, choppy trading, quarters of chop, 2022, I made all of my return was good, but it was all made in Q1. The rest of the year was just chop. That's frustrating, no matter what you want to change. And every client wanted to change the strategy or do something different or, but once again, it was there was no trade to be made. The best thing I could do at that point, and exactly what I told the clients, was my job right now is protecting the money. Like, it's not about my returns or my gains or anything or pushing harder to make something happen. It's protecting the money. The market was choppy. There weren't trends happening. There wasn't like a magical thing I could buy or sell that was going to make a ton of money. It was because that doesn't exist. It was just that was the trading period at that time. So looking at it, you look at Mulvaney, but and this kind of goes to my point. You see some of the years, like there's these down months, down months. I mean, he's having in 2022, which he had a really great 2022. He probably had the best performance in 22 out of everybody I've ever met. Most people who had good returns in 22 were single digits. The big funds who hit single digits, meaning 1 to 9%, they were doing really good. I was at almost 30, which was really, really good. Mulvaney's at 89% in 22. But you see, he didn't change his strategy in November when he had a 20% drawdown, or October, before that. And same with July, he had a 13% down month in July. So, I mean, that's one of his best years in 2022. And that's because the way he trades and the strategy he does trade. So if you think about, and I'll break that down in case people don't know how Mulvaney trades. Mulvaney trades if you're, for example, that year, currencies were getting hammered. So if currencies are getting hammered to the downside and someone like Mulvaney is trading it, he pyramids. I don't pyramid. I don't really like pyramid trading. But Mulvaney does, and he does it well. I've never found any strategy that I've back tested that says pyramiding is good, but he does a great job. So hats off to him. He kills it. So he basically shorting bonds, shorting currencies. You add to these positions. And then during those periods when you had the huge drawdowns in those, he's making a ton of money while everybody else is kind of just chopping around. Like myself, we're chopping around. So he's making a ton of money in those periods. But to the other side of it, you see 2021, and I'll bring that back up one more time. You see a year like 2021, that was the perfect trend following year. And if you are a person who really leverages trades and stuff, like you could have had a, triple digit year and greater. And you see 2021, he doesn't have quite the same year. And the reason why is when you're pyramiding, also it can go against you. So I think the end of that year, if I remember correctly, like it gave back a lot of gains in November and December. And so, you basically start to get stopped out on a few trades. For me, these are very small drawdowns because I'm not pyramiding. For him, you can see it's a 20% drawdown in November. So it's just, and I'm not hating on one strategy or over another. I'm just explaining his strategy and the good part about it and the bad part of it. And he would say the same thing. This is the good part of the strategy. This is the bad. The thing about it is fit the strategy to yourself. I don't care if I say it's a good strategy. You need to figure out if it's a good strategy for you. And Paul obviously has found a strategy that fits him. So long story short, I think the goal of the conversation today is figure out what strategy fits you and really rock it. Don't be afraid to put on those trades and do the trades that you have to make that strategy work, and continue to put them on when you're in a drawdown or in a bad period. If you see Mulvaney, I mean, he's 20% down. It doesn't mean he doesn't put on the next trade. You got to put on the next trade.
I think that is true for any type of trader. No matter what your P&L, you have to put on the next trade. Doesn't matter if you have a 10x winner or a 20-30% loss, you still have to put on the next trade because no one's going to pay you for what you have done in the past. So when you were bringing this up, so I just had another question for you. So you're long Coco for the second time uh, again, right? And you took the signal. So Coco, for those who don't know, it's gone straight up like a 45-degree line. Now, when it's going up so much, it means that your volatility has increased, which means the swings that you have on your Coco position are greater than the swings your first Coco position had. So now you have a bigger drawdown and it takes up a lot more of your capital. So when you look at this new trade versus the previous trade, how do you size it? Do you size it the same way or do you size it differently?
So that's the important part of this. I'm going to look for this chart right now, so I can bring it up for people. But that's an important thing that you bring up there because it's the same trade every time, and what that means is now that the volatility is higher, the position size is smaller. So that's an important thing to think about. When you're trading something like this, you understand that these moves will start out with low volatility and usually end with high volatility. Now that we're all the way up here and the trade's going on again, now that position where it started before, I'm going to be half the size as where I'm starting now. And this helps you to really hang on and hang in there on those major trade opportunities. So let me see if I can, you know what, I'll just share screen so I can kind of go through this with people because I know it's something that comes up a lot and we should really kind of dive into it here. Would be a good one to talk about. So let's see, share screen. All right. So here's the Coco chart. And something that's funny to talk about, and this is what we were talking about earlier, which is all the choppy trades that happened earlier in something like Coco. And then I'll get to the end in the volatility. So when I'm saying like, yeah, there's like, this is how a trend system will look in something like Coco. And Coco is always in my models. So that's another thing to also disclose. When you're looking at it and you're going, okay, well, you know, why is Coco always in your models? It's because the correlation to the market it doesn't have much of one. It can go up or down whenever it wants. Things like natural gas, it's always in my models. Things like Coco, it's always in my models. It doesn't matter what market regime we're in, it can do whatever it wants. And so because of that, it will be in the trading models at all times. So you see here, as we start on the left side of the screen, it's a small winner. Next one, in 2018, another small winner. And then small loser, and then small loser, and then small loser, and then small loser, and then small winner, small loser, small winner. So basically, you're talking about 4 years, 5 years of trading this without any return. So no return in 5 years. And then you get this crazy one. So basically, all of these kind of came out flat if you really think about it. Like the trades all are basically flat by the end of it. But then the final trade, you're talking about a 261% return. And now we have the new one on, which is here. So it's at 19%. So we got a 19% return here, almost 20. So when you're looking at this, the other thing that you asked and to talk about is all trades in a futures portfolio that's trend following based should always be the same size, because the idea is that you don't know where your winners are going to come from, and same size doesn't mean the same exact amount of capital. Same size means the volatility of the position. So if something like Coco, let's say the trades average 40% on the winners, and the trades for bonds average 10% on the winners. The trades in bonds are going to be a much larger size than a trade in cocoa. And so, as long as you're able to understand those things, and then you have a way of doing that every time, going, okay, down here, when this trade was put on, volatility was incredibly low. So I had a very larger position, tighter stop, and then you sail that to the upside. You get out of the trade, you wait for the new one, and you once again it's just measuring the volatility. So you could do this based on ATRs, whatever it is. And as long as my stop equals to 1% of my portfolio, that's the position that I want. So the volatility to stop always moves around. So the volatility to the stop loss, this is very complex stuff, but I'm trying to say it in a way that everybody can grasp it. The distance to your stop loss is always going to change based on the volatility of the product. So if Bitcoin is something that is the most volatile product in history, and you have to have 30% trailing stops on this thing, that's a really wide stop that you have to have on something like Bitcoin. Whereas a bond, I might be able to have a 10% trailing stop on it and hang on to that trade for the same amount of time as I'd hang on to a Bitcoin trade to catch that major trend. So I think that's the real key in doing this at a high level, because it's not about, there's all the, and you and I talk about this all the time. We laugh about this because you got like Druckenmiller and, people read the one thing in the one trade and they go, I want to short the pound. I'm going to make everything in the world. I'm shorting the pound. And so making everything in the world, shorting the pound, and being a pig and being greedy. It's what does he say? It's courageous to be a pig and blah, blah, blah. Most people get killed by being a pig. Let's be honest. Like, no, most people don't go in there and they put everything into one trade and they make everything in the world. Most people put everything into one trade and they lose it. The probability of that is always going to be higher than the probability of them making it, because the time frame has to come in so tight. So once again,
sorry to interrupt, but I think the Druckenmiller trade is kind of misunderstood. So he was trading FX, and in FX, if you have a position that's 100% of your capital, that's totally normal. You can even have a position that's 200% of your capital, and that can be totally normal. So as long as you don't have, as long as you use stops and you structure it right, you're not really going to risk. What would we have risk? Maybe 5% of the fund on that big position. Probably that's it. And I think when people read that you risk 200%, 300%, they kind of think that if the trade had gone the other way, the fund would have been toast. And there's a follow up to the pound trade. So Soros, when he got kind of active with his open society activism, he made good money shorting some of the emerging market currencies, and then kind of developed a conscience. I don't know what he talks about it, but he lost a ton of money trying to prop up the Asian currencies as well. So they were all over the place on FX, and the drawdowns, I think, were not as heavy as the market would have you believe. Like, if you have a 200% position on a stock and the stock gaps down 20% because of some bad news, your fund is done. With FX, you don't have those worries. And I think they would have structured the trade in a way that they risk very little percentage of their capital. And that's something, obviously, like, you wouldn't want to say that part of the story out loud. You want to be known for being a pig. You want to be known for. But I'm pretty sure he would have managed the risk till it was extremely manageable level. And I'm sorry I interrupted you there, but I think that's a part of the story that doesn't get told. So
no, it's true, and also if you look at the amount of capital they put into that, it's like you're talking about 10% of the fund. Like, when people think about being a pig, they're thinking about 190%. So once again, it's very subjective, and so understanding, like, what is it when. So for me, for example, when I'm talking about superior returns, and I get that idea from Victor Sprandia, which is once I'm up 20-30% on a year, I will start adding leverage to a position, meaning if my distance to stop, I can have a little bit larger position sizes. So if my distance to stop is 1% at the beginning of the year per trade, maybe I end the year at 2% distance to stop. Now, once again, that's nothing insane. Like it sounds like I'm talking in a big way if I didn't say 2%. But you could if I just left out the 2% part, you could grasp that as, oh, Jason's putting on major leverage. Jason's really excited about this trade. And really, I think the ability to think of trading as I'm going to do the best I can, like whether you're discretionary or systematic, I'm going to do the best I can. I figure out how this trade's going to um, probably work. Okay, so I figured out the probabilities are high. I'm going to place the bet, but also understanding at the same time, one bet isn't above another. And if it is, you probably shouldn't be trading the low probability bets then. You should only be trading the high probability bets. And if you can come into the market and do that every single day, where you're just looking for the highest probability bets and you take those trades every single time and you don't mess with the ones that you're like, oh, well, I kind of like that. Or this dude over here is really interested in this product that I know nothing about, but I'm going to put on a position. If you can stay away from all of those things and just take those A+ setups over and over again, you're going to do well here. But if you're coming into trading and you're going, well, this guy's saying this, or this guy's making money in this one, or I read a great piece of research, even though it's the opposite of what my strategy is, everything in my strategy is saying long a lot of things right now. In the equity market, I'm very short bonds. I'm short some currencies. I'm short a few agricultural commodities, but I'm pretty much long a lot of other things besides that. And it would be like me saying, okay, I saw some research. This guy said a buddy of mine hit me up today and was like, this guy's saying that Nvidia is going to hit $9. And that would be like me going, okay, I'm going to buy $9 puts on Nvidia, with my whole portfolio because this guy said it. Like that sounds ridiculous. It's the same as, you're in a year where you're going, okay, there's a lot of things to be fundamentally bearish about and technically bullish about. If you're a technical trader, like you should just be bullish, and that's what you do. And if you're a fundamental trader, and I'm not talking about people like us who do a little of both, just talking about people who are in one camp or the other. And if you're fundamental, I don't have a problem with you being bearish. Like once again, it's a understand the way you trade and you'll do this well. But it looks like our time is up. You got anything to add?
Yeah. No, I think we covered a lot of things, and this has been a great conversation. Kind of thing we don't talk about a lot, which is no stock picks, no outlook on the markets, nothing about the Fed, just talking about trading, the way we approach the markets. I think this was a great conversation, so we can probably end it there.
Cool. And we did get one question right at the end. What about silver? So I did post something just recently. So if I know you're on my channel, so please just check the page. I did post something about silver recently that just, basically buying dips. Looking at the dollar, top end of the range, probably the dollar coming down is going to be positive for gold and silver. I would continue to buy silver on this dip and pullback. That's about all I wrote about it. You have any thoughts, Gashop?
I think for the first time, managed money is net long silver. I haven't seen that in a while. I don't know if that's just silver catching on or if it's a contrarian indicator. I wouldn't read too much into it. Chart looks good. It's a buy. It's as simple as that.
Nice. All right, guys. Thanks for hanging out with us, and we'll see you guys next week. We're here on Mondays at 11 a.m. and Fridays at 11 a.m. Eastern Time. See you guys soon.